we'll go ahead and introduce Brian, and I guess he can start uploading his presentation. It's always good to have Brian in the discussion. He has a very, good background in spring wheat and is kind of from this region, so he kind of knows a little bit. Brian started his career working in the open outcry pit at the Minneapolis Grain Exchange. He was a licensed broker and wheat market analyst for a national co-op based in the Twin Cities. He joined United Grain in 2011 as their spring wheat merchant. And in 2020, he was made director of merchandising for United Grain. So it's good to have Brian here. Erica and I have both worked with him a number of times with customers. That's kind of the focus he's going to get into, is all the questions related to spring wheat demand and what's going to happen as we go forward. So I see your first slide, Brian. I see your pointer, so you should be good to go.
All right. Thank you very much, Jim. That was a very nice introduction, and appreciate everyone's time having me be here, listen to kind of an exporter's perspective on the market, let's try and say here. So I'll go through a little bit about United Grain, kind of the things we're viewing in the market. Obviously, the great work done by Miss Olson and Mr. Kruger already have laid some pretty good groundwork. So try not to get too lost in the weeds on some of the retreaded stuff, but twist it and make it a little interesting for those of you. So with that, let's get rolling. So a little bit about United Grain. We're a grain exporting company. Primarily all we do, we export roughly 230 million bushels of grain a year. And that's a mix of corn, wheat, soybeans, and odds and ends along the way, sorghum, canola, some other stuff. But you can see we operate a network of facilities across the Northern Plains. Every one of these facilities we handle spring wheat at. Kind of go through some of them. So when United Grain reformed in 2011, we had the export terminal in Vancouver and 2 shuttle loaders in Montana. In 2012, we expanded with the addition of 3 more shuttle loaders, including 1 in Southwest North Dakota. And then again in 2017, we added another shuttle loader in South Dakota, as well as some barge facilities here along the Columbia River. So just around the horn here, you can see some of our facilities. This is our shuttle loader in Pompey's Pillar, Montana. This is beautiful Bucyrus, North Dakota, and our barge facility in McNairy, Oregon. So as I said, about 230 million bushels annually for United Grain here. This is our export facility, and this is what a Panamax size vessel looks like. So a Panamax size vessel is generally thought of as 60,000 tons. When it comes to wheat, that's about 2.2 million bushels. So these are some of the statistics we just did last year. We loaded 119 vessels. We unloaded 468 barges. We unloaded 46,868 rail cars. So really high volume. It's a good market to be in because we're so close to the Pacific Rim, where a lot of the strongest spring wheat demand is, as well as buyers who really like the quality of the U.S. product. So kudos to you as growers for growing such a high quality product that these buyers really enjoy. So this year, obviously, it's been a wild one for sure. I mean, you go back 12 months ago, a full calendar year, and think back to where we were with what was going on with COVID, what was going on with the extreme markets going up and down, government interventions. So 2 of the biggest things we've seen happen over the last year. One is the weather. Of course, that top left picture you can see there, a good indication of the way it's looked and felt for most of us here in the Northern Plains this year. And then the roller coaster it's put the markets on. Obviously, government intervention is something we always have to observe as exporters and anyone in the market. The change in the U.S. government policies to be a little more protectionist over the last 5 years have been something that's difficult as us exporters have had to deal with, while simultaneously taking some steps to be more supportive of the domestic farmer and just generally stimulus money that increases the money supply has been an upward pressure on commodities, but it's been a downward pressure on the value of the US dollar. So that's helped a little bit for exports. And then we talk about what's driving our market. I mean, this is just a smattering of anecdotes, but everything you heard from Ms. Olson, Mr. Kruger, it's been hot, it's been dry. The Brazilian corn drought, as Mr. Kruger's chart showed, going from what was at one point perceived to be 110 million ton Brazilian corn crop. It's looking more like it's going to be 90, maybe even a smattering less than that. Really has tightened the world corn balance sheet back into more equilibrium as opposed to oversupplied. And then domestically in the US, there's been really good moisture and really bad moisture. The good moisture for the eastern corn belts, the southeastern part of the United States, versus the western half of the United States and the Northern Plains have been very dry. And just a couple weeks ago out here in beautiful Portland, where I reside, we got to endure a week of 116-degree temperatures, which was hot. Just for reference, the previous highest temperature ever recorded in Portland was 107 degrees. So oof, the hot weather has been something special this year, as I'm sure I hear you guys are enduring some of that today in Fargo and the greater North Dakota area. Of course, where does this lead us? To some uncharted territory. Having, in a lot of time, never been this hot before. Some areas have never been this dry before. What does this mean for production? You look at this North American map, how much of this just reds and oranges are splashed all across the spring wheat growing areas. Right next to these two, you can see one of the severe long-term drought areas coincides right with the Canadian central production areas. So as we heard earlier, things in Canada are looking like they're going backwards in a hurry, just like the spring wheat crop here in the United States has. So if we look back and what does this mean? Well, the last time we had weather like this in Canada was 2002. And what happened that year is yields came in about 25% below trend line. So if we start thinking we're going to see something similar this year, it could have a very serious effect on the Canadian balance sheet. You look at some weather maps laid side by side. Here's rainfall in 2021 versus rainfall in 2002. Temperatures 2021 versus temperatures 2002. So I don't think it's any stretch of the imagination to say we could be setting up for a pretty significant reduction in spring wheat growth in Canada in that same 25% area. And we can see here, what does this do for the balance sheet? This is the latest USDA balance sheet for Canada with their exports still at 23 million metric tons. If we were to reduce their yields by 25%, as we saw in 2002, you can see this production falls, just as Mr. Kruger had said, from 31.5 down to 23. And of course, to make the balance sheet flow through, you got to chop 7 or 8 million metric tons out of their exports. So what does that mean for us here in the United States? I guess is the real question. So obviously, we've all seen anecdotal pictures of wheat crops. You know, I try to be a pragmatist, and normally if someone's not holding today's newspaper and a GPS monitor, I don't really believe the crop pictures, but I think I've seen enough of them this year that it's definitely looking like it's going to be bad. Some of the conditions work that was done by Ms. Olson earlier, this is just another way of displaying it. Going back to 1988 was really the last time we've been in situations like this. And similarly, we look at the drought monitors side by side. Here's what 1988 looked like, more or less all of the spring wheat growing area of the United States. 2021, while it's been dry, it's not been as dry as it was in 1988. Now, I'm sure these purples and dark reds are of little comfort to growers out there watching crops that look like this. But for that reason, we can probably realistically expect the crop to turn out somewhat better than 88, but still it's going to be a very down year. And of course, between Canada and the United States, the futures outlook is trying to price all this in as best as it can. So now this is a continuous chart of Minneapolis. You can see our last drought scare, 2017, prices kind of came up and just kissed $9. And just last week, we blew through the $9 mark here in Minneapolis futures for the September contract. I guess where are prices going? Always an interesting question. But right now, I don't see any significant resistance below the $10 mark. So if the weather pattern holds, we probably have to work our way up to this level to satisfy at least the technicians. And then from there, we'll see. Now, there's temptations to talk about 2008 and $20 wheat. I think we're lacking a lot of those ingredients. And we'll get into that here as we flip forward here, but I still do think there's some upside left in these Minneapolis futures. All right, so just the long wordy slide that everyone loves to read together out loud. Spring wheat production, you can see USDA at 344. Of that, 305 is hard red spring. We take out the white wheat grown in the P&W. Record low BPA. You know, it's left to be seen. I think the yields actually come out a little bit better than that. But as Erica was saying, the production probably matches out as I don't think we're going to get to this 97% harvested. Drought years, we tend to see more like 10, 15% abandonment. So at the end of the day, we probably gain a little in yield, lose some in abandonment, and still have a lot of work to do to make the balance sheets work. So we got to figure out a way to ration demand, about 7 million tons of Canadian wheat and 3 million tons of US wheat. We have to figure out how are we going to replace this, and can we go without this? Look at these WASDE numbers side by side here, our spring wheat column. The big ones we have to look at here are exports, cutting out 64 million bushels, helps reduce the export situation. We'll go line by line through some of this as we try and figure out how do we make a crop this much smaller, production 305 versus 530. How do we make that work on a balance sheet? So let's just go through the numbers, run the numbers and figure out where we get. So production is going to be down 225 million, according to the USDA. They took up imports 33 million, which obviously with what we said is going on in Canada is a little suspect right now, but presume it's the number we got right now. And then take down domestic use, 67 million bushels. So how is this going to happen? Mills will increase the grind of HRW. The blends they use, they'll use higher protein spring wheat and lower protein hard red winter wheat. We won't feed any spring wheat this year. So with those increases in supply, with our cut in demand, leaves us with 125 million bushel gap we got to fill. The USDA is expecting about half of that to come from exports and half of it just to shrink the stocks that exist. So when we talk about spring wheat, one of the things we often talk about is the inelastic demand. And while this is true versus any wheat class we have out of the United States, spring wheat, it's easy to argue, is one of the least elastic. There are ways we can chop away at some of this demand. So some of the captive buyers that are stuck, Japan, Taiwan, Korea, these advanced Western economies where they are not price sensitive markets, and even further have political agreements in place that make them dependable trade partners to the United States. They're the ones that are going to buy probably regardless of price. When you talk about $20 wheat, who is buying it? These are your friends that were buying the $20 wheat back in 2008. The Philippines, which has become the largest market for US wheat, will probably look at lowering their specs, finding ways to curb costs. They are a price sensitive market, though heavily dependent on US wheat. Will not be surprised to see them try and maybe blend more HRW into their spring wheat to stretch their supply, just like US millers do. We'll see competition from prime hard out of Australia, spring wheat out of the Baltic area, and HRW just will take its bite out of US usage abroad and domestically. We talked about that spread, Mr. Kruger, the Minneapolis versus Kansas City futures out to $2.65. I mean, pretty much at record levels. The last time we were here was when the 2017 spring wheat drought was talked about. And you can see going all the way back to 2013, we haven't been in areas anywhere close to this. So how do we get rid of the demand? I guess we already have one really recent example of demand destruction. If you remember back in late 2018 to 2019 into the middle part of this marketing year, we had a trade war with China. You can see this bright orange bar represents Chinese consumption of US spring wheat. Well, when a trade war happens, it's very easy to see demand dropping to next to nothing. Now, of course, it bounced back pretty hard last year with the end of the trade war, the resuming of normal trade patterns. But if we've got to fill a big hole in the balance sheet, Chinese wheat demand looks like one area where we might be able to find that extra supply. But let's go through the whole picture and figure out how we're going to get there. How are we going to get rid of the 64 million bushels of demand? So these are the 10 biggest importers of US spring wheat. This column right here in million bushels shows how much we did last year. And this column is the smallest amount any of these countries have done in the last 5 years. So if every one of them were to simultaneously take the smallest amount they have in the last 5 years, you can see we can chop 90 million bushels out of export demand. I guess this is where I stop and say, is $20 wheat around the corner? Probably not. We've got a good carryout. We've got hard red winter wheat. Russia exists as a world supplier. All these things we didn't have in 2008. And we've seen in the last 5 years, demand can be rationed. This column here is a more likely scenario of what's going to happen this year to ration out the 64 million bushels. The Philippines demand dropping by about 10%. The Philippines is a big growing economy and loves US wheat, but this is where we'll find some of it. The Japan, Taiwan, Koreas of the world, the inelastic, we're going to leave roughly unchanged, but we're going to grab 25 million bushels of supply by saying we're going to drop the Chinese business back down to nothing. Mexico, we'll see them switch to hard red winter wheat. That grabs us another 12 million. And then some of these marginal buyers, you just pluck a little bit here and there. We're at our 64 million without breaking too much of a sweat. So USDA projects exports down 64 million. This is achievable. So the balance sheet can work out the way the USDA has it now. It will change the profile of the demand for spring wheat though in the market. As we see some of the buyers with less elastic demand versus buyers that have more elastic demand, you can see every buyer has a different spec of spring wheat. So what we're going to see happen is 14 Pro, high falling number wheat, DHV, not a big concern. I mean, this is wheat that North Dakota generally produces very well. We'll see that demand stay stable. China tends to be a higher protein, very high DHV buyer. Well, North Dakota rarely struggles with the protein, this min 75 DHV. If we lose all that Chinese demand and we see a 10% cut in the Philippines, you probably see a less emphasis placed on DHV and more emphasis placed on things like falling numbers, quality. Japan, though, a number 2 buyer, is very high quality buyer. Korea, number 1 buyer. So things like test weight, shrunken and broken, those are going to be enemies in a drought-stricken year where our buyers are going to be high-quality buyers that are sticking with us. So just to wrap up, some final thoughts on spring wheat here from an exporter's perspective. The crop's going to be short, perhaps historically short, and Canada's going to suffer as well. A lot of my presentation here has been talking about the market's job is then going to be to ration that demand, and the market's extremely good at this. As it stands now, our balance sheet can work. Prices should remain high to make sure we don't encourage additional demand, but it appears that this $9 to $10 mark on futures, we're high enough priced on a global basis that we're doing enough to dissuade additional demand right now. And just a word to the producers, prices will not go up forever. The market tends to overdo it. It gets exuberant. It will probably get these futures up to $10, perhaps even higher. But, don't forget to sell if the opportunity is there in front of you. We're not going to run out of spring wheat. The market can ration demand as it stands now. So take advantage of what the market gives you and work with your buyers, work with your advisors, and make sure you engage the market. And a big thank you to the North Dakota Wheat Commission. Thanks to Jim, Erica, everybody for allowing me to present here. And thanks to all the growers and participants for listening. I appreciate it.
Okay, thanks, Brian. Excellent presentation as always, and certainly can tell that you've put some time and effort into kind of breaking out that demand, because I think that is the question, of a lot of producers that, like you said, spring wheat is a little bit more inelastic in demand, and they know history, what has happened, and I know one of the things I always struggle with is, is perception as bad as reality? And I think you've kind of laid out some of those real world perspectives on at least what we need to keep in mind going forward. And Erica, I see there was a few questions in the chat and we have a little bit of time. So again, thank Brian for his presentation. I don't know, Erica, maybe I'll let you kind of handle the questions, and then some of these might be geared towards Mike a little bit too, but I'll let you go ahead and answer or ask questions.
Okay, so Brian, the first question is, and I guess you touched on this a bit, but do you expect exports of spring wheat to fall below the 220 level? I mean, do you think they can, you talked a lot about demand rationing, but do you think they could fall even lower than the USDA estimate?
Yeah, there's a world where it can. Obviously the one slide I put up showed that if everyone in the last 5 years, and that was just a snippet, those are the 10 biggest spring wheat buyers. There's a bunch of other buyers in the world we can ration as well. But if everyone took the smallest amount they had in the last 5 years, there's an additional 30 million bushels we can chop out. Now, the world changes every year. Some of these countries like the Philippines that have been growing at 5 to 10% a year consumption, taking them down 10% could really be a big cut. I think the low-hanging fruit like China, there's a few others, Bangladesh, Sri Lanka, just little one-off buyers, but it starts to get really painful after you chop probably another 10 to 15 off of this number where it's at right now. If we wanted to get to that last 15, the bare minimum, it would be painful for some world buyers because they've just become so accustomed to buying US wheat. It's such a good product for them. It can't just easily be substituted. I personally hope we don't, because these are our customers, our partners. They pay my salary, help keep the prices good for the growers. I really hope we don't have to turn them away and make them find alternative sources, because then you got to do the work to bring them back. So it's possible, but I hope we don't have to.
Okay. So how about protein premiums? Do you anticipate those coming back at all? Just, we're hearing of a little lower protein in the winter wheat crop. What are your thoughts on that?
Yeah, that's a good question. Generally, in short crops, drought-stricken years, we tend to see high protein. We actually just saw protein scales invert last week on the Minneapolis spot floor, where some mills are obviously starting to get worried about getting applied too much 15 protein on their 14 pro contracts right now. I think we're destined to go to probably 0 to a very small upscale at harvest. I mean, inverted protein scales are never sustainable. The low protein hard red over the course of the marketing year, once we get through that push at harvest, might help to garner some small protein premiums because we can blend high protein spring wheat with wheat from Kansas, but I would guess the overall crop profile will limit that.
Okay, next question. This person states, I believe there's going to be a battle between the domestic and foreign demand for spring wheat next spring. Do you agree? And do you think that could potentially lead to higher prices than the board indicates now?
It's possible. I mean, if the crops continue to get shorter, end up coming up smaller than we expect, I guess part of the question is who does a better job at their own demand rationing? Who comes up with better blends? Domestic millers tend to have an advantage because they have hard red winter wheat here nearby where they can stretch their supply farther if they can figure out a blend that still satisfies their customers. Overseas buyers are a little bit of a disadvantage. In order to get competitive freight, you have to buy huge quantities at once, and it's a big risk for overseas mill to all of a sudden, if they're not used to blending spring wheat and winter wheat together, to buy half a boat of spring wheat and half a boat. I mean, it's 30,000 tons of winter wheat, some product they're not accustomed to using. So they end up probably having to pay with their wallets more, while domestic mills have more opportunities. They can blend a few rail cars at a time. They can adjust their blends on the fly. But to get back to the heart of the matter, yeah, it's possible. I mean, if neither side can find out a way to ration demand enough, we could see some price spikes. I think the domestic millers are in an advantaged position though, with a big, high quality, low protein hard red winter wheat crop this year.
All right. And this next one, Mike Kruger might want to give his input too, but Brian, we'll let you have the first stab. What have you seen in basis movement these past couple weeks, and what could we see moving forward?
So P&W basis, export basis, has probably been up 40 cents a bushel in the last 2 to 3 weeks, which is a huge move. I mean, we spent all of last year just in a malaise. I mean, last year we had too much spring wheat. We had more than the export market needed. So basis was just a sideways bleed lower constantly. And then this summer when the board started to spike, it really hammered our basis, where we went from kind of a consistent 150 over delivered to the P&W all the way down to 100 over. And then now we're probably back up to that 140, 150 while the futures are spiking also. So a classic rally. You see basis, futures, and spreads all rallying at the same time, and we've seen that in Minneapolis. So I guess I would expect the structure of the market to remain strong and firm going forward, basis, futures, and spreads.
Okay, and Mike, did you have anything to add from your end on the basis? Not to put you on the spot, but.
Yeah, no, I don't follow it, of course, nearly as closely as Brian does, but I agree with him. I mean, it's all happening at the same time, and I guess the question is, how long does that last?
So Brian, just one last question for you. I mean, I know you deal specifically more with, I mean, we've been discussing mostly spring wheat, but do you have any perspective on the soft red winter wheat? Any price outlook for the next month to 2 months for soft red winter?
I think, so soft red winter wheat doesn't really flow to the P&W. So it's not a market we trade a lot. I guess the recent Chinese purchase is encouraging. I guess just the thing soft red winter wheat has going for it right now, it's relatively cheap when you put it into a world price matrix, especially basis other U.S. wheat. Just 2 weeks ago, we lost some Latin American demand that's traditionally been white wheat out of the PNW to soft red winter wheat out of the Gulf, as the white wheat crop was equally stressed to the spring wheat crop this year. So I see some structural support for it, just being the cheapest wheat. It's gonna, it's gonna attract buyers. Anyone who can use it for feed, anyone who can just use it as a filler, it's gonna get some support. But it tends to wash through the system relatively quickly and then be relegated to kind of an afterthought once the harvest is over and everything's put away. Unless you see a sustained Chinese purchasing campaign for feed, it probably trades as just a sideways market and is a derivative of what's corn price, what can we feed wheat to replace it. And that's kind of the outlook I have for it this year.